Rohit Srivastava, founder and strategist at India Charts, joins us this morning. Rohit, good morning. Pleasure having you back with us on News 9. Mood this Monday morning seems fairly damp, doesn't it? Is it just Wall Street and fears of the AI bubble, or is there more to read fundamentally into what's likely to happen in the markets this week, looking at the charts this morning?
No, I think most of Asia and including India just reacting to what happened in the US. And what happened in the US, I think, has more to do with a buy on expectation and sell on news kind of event around the Fed.
Okay.
It might not have so much to do with the AI bubble talk because you still have growth in AI stocks. They are not at crazy valuations. It depends on how you really look at it. But I think what really happened on Friday is bond yields went a little higher, higher than they were on Fed day, and that got markets a little spooked. But many times, around Fed meetings, we get these wild swings before and after the meeting,
Okay.
which is sort of just discounting the event. I think the actual moves will become more visible in the next 2-3 days, and that is what we should really be looking for. So therefore, I would call today's move just reaction to post-Fed meeting profit booking. If you look at the Nasdaq rally pre-Fed meeting, it was pretty strong. It went up for 1 to 2 weeks.
Right.
There's a couple of days of correction after that.
All right. So this seems to be just investors digesting the news and digesting the commentary from the US Fed. Meanwhile, I'm looking at auto stocks this morning, and there seems to be a bit of a bloodbath on auto stocks, Rohit. I'm looking at M&M, which is down about 1.6%, Eicher Motors down about 1% or so, and pretty much the entire Nifty 50 auto pack in the red this morning. Just simple profit booking consolidation, because it seems that the sector has also been in some sort of a consolidation mode ever since we saw the rally after the announcement of GST cuts.
Well, it has been a sector that has also done well. It actually outperformed the Nifty when it was flat to down. Therefore, maybe, so again, I think today's reaction may just be based on, movements in bond yields versus what the central bank actions are. I think both in India and the US, what we are seeing is bond yields are not coming down even after the central banks have cut rates. But they do have plans to buy bonds, directly from the market, whether it's the 40 billion per month in the US or whether it is OMOs of, over 1 lakh crore, which the RBI has announced. So that is likely to, contain that volatility that we are seeing in the bond market near term. And so I think autos, which are interest rate sensitive stocks, would continue to do well because, see, you match it with the next best sector. On Friday, we saw metals do exceedingly well, and they are sort of flat. They're not down so much. And same with financials if you look at Bank Nifty. So maybe autos is the odd one out right now. But I would only see that as a reaction, maybe some positioning that got excessive.
All right, some excessive positioning potentially. I'm also looking at energy stocks this morning, Rohit, and ONGC seems to be one of the biggest losers on the Nifty 50 pack this morning. The stock is down almost 3% or so in trade. Overall, again, the energy pack also, despite not too much volatility or movement in global crude prices, this is a sector that seems to be reeling under some pressure this morning. What's likely to be the reason behind this?
So it may be ONGC specific. See, we saw some very good moves in the oil marketing pack. So I think that is really looking good, where I'm referring to the likes of HPCL, BPCL, and they all picked up on Friday, showing early signs of another rally kicking off. And if we compare ONGC, say, with Reliance, then we find that Reliance is, barely down, only around 0.5% after having, jumped up from 1,520 all the way to 1,560. So it's not really lost that much. So it may be very specific to ONGC, which has actually been falling, for quite some time. For some reason, I would have to really delve deeper into it, but it's actually falling since, I think, 31st of October.
Right.
It's been in a downtrend, so we really need to wait and see where ONGC bottoms out.
All right. I want to sort of pivot, Rohit, now to a broader trend which we witnessed this entire calendar year, and that is to do with the FPIs pretty much dumping Indian equities. In fact, 2025 has now become the year of foreign investors selling equity, both Indian equities as well as Indian bonds. Now, as per a report by the Hindu Business Line, out of the 234 trading days until December 12th, FIIs have been net sellers on 141 of those trading days, with this figure being all set to exceed the 146 net sell days recorded in the year 2022. And till date, the highest number of net selling days in India in the last 2 decades was recorded back in 2008 financial crisis, when the sell days rose to 154. Now, net outflows till December 12th had increased to more than 1.5 lakh crore rupees. In fact, 1,52,273 crore rupees. Now, when distributed across all trading days of 6 hours each, this figure indicates that around 110 crore rupees exited the Indian market every trading hour this calendar year. Now, this selling peaked on December 10th when FPIs pulled out as much as 5,386 crore rupees in a single day. Now, multiple reasons behind this. Rohit, I want to understand from you, one of the reasons that seems to be is the sharp depreciation of the Indian rupee, which has weakened to record levels in recent weeks, which has further dampened foreign investor sentiment. So, in your opinion, do you think there should be a little more RBI forex intervention to arrest the fall of the rupee, at least in the interest of FPIs staying committed to the India story?
No, I think that's a circular argument, because what causes the currency to weaken? Is it the FPI selling that causes it to weaken, or is it the weakening that causes FPI selling? So we can go in circles on that. So you have to really come down to the fundamental situation as to why the rupee is weakening right now. I think the RBI used to intervene a lot a year or two back, and to some extent we would call that over intervention. I think we are in a situation which is much better. You need to allow it to weaken a bit, because otherwise it gets excessively strong against competitors. And in the current environment where we still have those tariffs on us, it's actually helping exporters to some extent, getting a weakening rupee. But now if you look at the underlying, our current account deficit, which used to be over 2%, 5-8 years ago, is now, had gone almost to 1%. It's risen a bit because of the tariffs. But it's still well below 2%. So in that sense, we have a much better reserve position. We have a much better current account deficit situation. So that's not really the cause of the weakening. But definitely in the near term, you've had high gold prices. So that does result in gold demand, gold imports, which often affect trade flows and the currency itself. And of course, FPI flows, which have been weak because they've been supportive of markets historically. But for a long time, we've not seen that. And we also need to look at, when we talk about FPI flows, you have to net it off against how much money is really circulating out into IPOs. Because, when you look at CDSL numbers versus the daily NSE data, sometimes the outflows are not that big. But still, it has been a net outflow year. There is no doubt. But a lot of money gets circulated into IPOs as well.
Right.
And that's also the reason why we saw the mid and small cap selling last month, which was a lot of IPOs getting allotted, and people had to sell stocks to make those investments. So that's part of the pressure point that we've seen recently.
Right. So interesting, this entire circular conversation around whether it is the FPIs which are leading to the decline in the rupee, or a weak rupee which is leading to the exodus of FPIs. But also, there's this question of rich domestic valuations which are making India relatively less attractive as compared to other emerging markets, which are potentially offering better value to foreign investors. So do you think it is time, as we come to the end of 2025, you're on the verge of entering 2026, is it time to revisit the discussions around frothy valuations, especially in the small cap and the mid cap space that you were talking about some time back?
So it's a very bottom up call. We've been scanning across stocks since we've started providing research services, and what we're actually doing is we're looking for segments and sectors where valuations have come off during this consolidation phase between 24 and 25. And I can tell you that there are a handful of such places where it's happened. In fact, if you just look at in the big caps, the biggest performing sector has been banking. At the start of 2025, banking stocks were at the lowest valuations that we had seen in a decade. And that's sort of what has driven money back from funds who've been consistently receiving the SIP flows, have been allocating more and more money to financial stocks. And so that's a trend we very, very clearly seen. So the simple point I'm trying to make is there are many pockets of low valuation within the average valuation. If we look at where the markets bottomed in COVID, it was at around 17 times historical P. Right now we are at closer to 19 times or 20 times based on that. And that's not very, very far off. The peak valuation for Indian markets has been closer to 30 times. I'm talking about the Nifty itself. And we are not there. So the valuation argument has to be sector specific and stock specific. I don't think this is an extremely overvalued market.
Okay, and which are the sectors which seem to be dealing with that high valuation right now? And do most of these pertain to the small cap and the mid cap space?
Within mid caps, it is stock specific. I think at a sector level, most would appear corrected because we have seen sell-offs in, say, power, energy, everywhere. I think almost every segment we've seen some kind of selling. And so if you look at sectors, you might not find significant overvaluation. In fact, you might find pockets of undervaluation. But when you look at individual stocks, some cases you'll still find price earnings at 80, 90 times, and some cases they've actually dropped from 100 to even 30 or 20. And we end up looking for those opportunities where the valuations have come off and growth is still persistent.
All right, and talking about valuations and extremely high valuations, I want to now shift focus to another commodity which has seen soaring valuations, and I'm talking about silver here, Rohit. Silver prices rose to a historic 2 lakh rupees per kg on MCX on Friday. Some analysts expect even more upside, indicating perhaps dips at 1.7 to 1.78 lakh rupees per kg could trigger some staggered buying, while the target seems to be about 2.4 lakh rupees in the year 2026. So Rohit, I want to understand from you, should the textbook example of asset allocation now be updated with silver rather than gold making it to the mix, at least for retail investors?
So two things here. One is that on a long-term basis, and long-term I mean 3 years to 5 years, silver outperformance relative to gold is definitely here to stay. The only thing people need to be careful about is, when do you buy? If you didn't already buy silver as part of your portfolio allocation, then this is probably not the right time because we've gone through multiple months of gains. And when I look at the monthly chart, a very simple technical indicators, the RSI, on gold, it's at 92. On silver, it's at 87. On such readings, we typically would not want to be making fresh purchases. We would really want the market to correct and pull back. One of the intermarket divergences that we study is that you have seen new highs in silver recently, but you haven't seen new all-time highs in gold. And when you get that kind of an intermarket divergence, it's an early warning of a trend reversal.
Okay.
But when I'm saying trend reversal, this is not long term. This may be applicable for the 3 to 6 month period.
Okay.
And that is where what we are saying is that if you have excessively allocated to precious metals relative to equities, this is probably a good time to shift back from precious metals to equities and consider precious metals again once the correction is done.
Okay, and do you think given the kind of rise that silver has seen from 1st Jan 2025, I remember silver was trading at 90,000 rupees per kg, and on Friday it touched 2 lakh rupees per kg. Given that sharp rise that we have seen on the graph of silver, is it time for some switching of allocation from gold to silver once there is some sort of a price correction or the RSI reading that you were talking about on silver?
Yes, definitely. So we look at the gold-silver ratio, and it's a very long-term indicator. Some people try to trade it short-term, but we look at a 20, 30-year chart of the gold-silver ratio. All the most significant peaks, are done at the top end of the range. We've actually just come off the bottom end of the range and started to break out higher. So there's a very clear sense that in a precious metals bull market, silver tends to outperform gold. And we are not done with the bull market yet. So definitely on a correction, you want to own more silver than gold if you're looking at returns through the precious metals bull market.
All right, Rohit Srivastava, let's leave it at that. Thank you so much for covering that entire gamut of everything from FPI sell-off to adding gold to your kitty and, of course, the mood on the markets this morning. As always, pleasure having you here with us on News9.